The hegemony of the US dollar, structure, power, persistence, and the transformation in the global monetary order. Introduction: currency as an instrument of structural power. The dominance of the United States dollar in the international monetary system represents one of the most significant structural realities of the modern global economy. Currency is not merely a medium of exchange, it is a technology of coordination, a repository of trust, and a tool of geopolitical leverage. Since the mid 20th century, the dollar has evolved from a national currency into a central organizing axis of global trade, finance, and reserve accumulation. Its influence extends far beyond economics into diplomacy, military alliance, institutional architecture, and the strategic autonomy of states. The hegemony of the dollar has created a system in which the United States enjoy a unique ability to finance deficits, shape global liquidity conditions, and exert indirect influence over international policy outcomes. The persistence of dollar dominance cannot be explained solely through the economic productivity of military strength. The persistence of dollar dominance cannot be explained solely through economic productivity or military strength. Rather, it is the result of institutional design, network externalities, strategic agreements, and historical contingencies that collectively granted self-reinforcing advantages. The dollar became embedded into the global market through legal frameworks, commodity pricing conventions, financial infrastructure, and expectations about stability. Understanding the structure of dollar hegemony requires analyzing how monetary power interacts with political authority, how liquidity becomes influence, and how global actors coordinate around a shared unit of value when alternatives exist. Despite its resilience, the dollar system faces structural pressure generated by technological innovation, geopolitical fragmentation, and gradual diffusion of economic growth towards emerging economies. The rise of alternative payment systems and the expansion of China's economic reach, as well as the development of digital currencies, introduce variables that may alter the distribution of monetary influence. However, shifts in international currency hierarchies occur slowly because monetary systems rely heavily on trust, credibility, and institutional depth. The global economy remains embedded with dollar denomination contracts, securities, and financial norms that are costly to replace. Today, I would be examining the historical formation of dollar hegemony and the structural mechanisms that sustain its dominance. The geopolitical advantages derived from reserve currency status and the potential forces that may gradually reshape the international monetary order. The analysis emphasizes the interaction between economic incentives and power asymmetries, highlighting how monetary arrangements influence the strategic options available to states. Historical foundations of dollar dominance, the Bretton Woods architecture, and the institutionalization of monetary hierarchy. The modern international monetary system began to take its contemporary form following the disruption of the Second World War. The destruction of European industrial capacity and the relative economic strength of the United States created conditions for a new institutional framework designed to stabilize exchange rates and facilitate reconstruction. The Bretton Woods framework established the dollar as the central reference point for global currencies by linking it to gold while requiring other currencies to peg their currencies against the dollar. This arrangement created a hierarchical system in which the dollar functioned as the primary reserve asset, enabling the United States to supply liquidity to the global economy. The institutional structure reinforced confidence in the dollar because the United States possessed the largest gold reserves and the most productive industrial economy at that time. The International Monetary Fund and World Bank were created to support exchange rate stability and post-war development, further embedding the dollar within the global governance structures. The convertibility of the dollar into global established credibility and facilitated international coordination. The system aligned incentives among states by providing exchange rate predictability, encouraging trade expansion and reducing uncertainty regarding cross-border investment. Although the gold convertibility mechanism was eventually abandoned in the early 1970s, the network effects created by the Bretton Woods system persisted. Trade contracts, financial markets, and central bank reserves had already become deeply integrated into dollar-denominated frameworks. Once established, such institutions' dependencies became difficult to reverse because economic actors prefer continuity over disruption. Monetary arrangements function as coordination equilibria in which stability is valued more highly than experimentation. The petrodollar system and the commodity pricing power. Following the collapse of the gold convertibility system, the United States maintained the gold relevance of the dollar through strategic arrangements related to energy markets. Oil exports adopted the practice of pricing petroleum in dollars, thereby ensuring continued global demand for dollar reserves. Since energy is a critical input in industrial production, transportation, and national security, countries were required to hold dollar reserves in order to participate in international trade. Commodity pricing conventions play a central role in reinforcing currency dominance because they generate continuous transaction demand. Importing countries must obtain dollars to purchase oil, and exporting countries invest surplus revenues in dollar denominated assets. This market further reinforcing the attractiveness of dollar assets. The interaction between commodity markets and financial markets creates feedback loops that stabilize the monetary hierarchy. The petrodollar system dominates that currency. The petrodollar system demonstrates that currency dominance is not solely determined by market forces but can also be reinforced through geopolitical agreements. Strategic relationships between energy producers and financial centers create structural dependencies that shape global capital flows. Energy security considerations intertwine with monetary arrangements, illustrating how economic infrastructure can support broader geopolitical objectives. Structural advantages of reserve currency status: exorbitant privilege and fiscal flexibility. Reserve currency status grants the issuing country the ability to finance extreme financial deficits more easily than other nations. Because global investors demand dollar denomination assets as safe stores of value, the United States can issue debt at relatively low interest rates. This phenomenon allows the US government to sustain fiscal expansion without experiencing immediate balance of payment constraints. Other countries must accumulate foreign currency reserves before engaging in international transactions, whereas the United States can create the currency required for global settlement. This asymmetry provides significant macroeconomic flexibility. During periods of economic crisis, the Federal Reserve can supply liquidity to stabilize financial markets without facing immediate currency depreciation pressures comparable to those experienced by smaller economies. The demand for dollar assets function as an automatic stabilizer, absorbing shocks that might otherwise produce financial instability. The ability to borrow in one's own currency reduces exposure to exchange rate risks and enhances policy autonomy. The reserve currency issuer effectively benefits from global demand for safer assets. Treasury securities are widely considered low risk instruments, making them attractive to central banks, institutional investors, and sovereign wealth funds. The global accumulation of these assets supports domestic financial stability and enables the United States to maintain deep capital markets capable of absorbing large volumes of investments. Financial market depth and liquidity dominance. The size and sophistication of US financial markets contribute significantly to dollar hegemony. Liquidity attracts liquidity because investors prefer markets where assets can be bought and sold without large price fluctuations. Deep markets reduce transaction costs and create efficiency, encouraging global participation. Financial instruments denominated in dollars include government bonds, corporate bonds, derivatives, equities, and structured securities. The breadth of these markets allow investors to manage risks through diversification. The centrality of dollar funding markets means that multinational corporations often borrow in dollars even when their operations are located outside the United States. Dollar-denominated debt instruments create exposure to US monetary policy decisions. Interest rate adjustments influence borrowing costs globally, demonstrating how domestic policy choices can transmit internationally. The integration of global finance into dollar-based systems create dependencies that reinforce the currency's dominance. Financial innovation has historically occurred within dollar markets due to the availability of capital and institutional expertise. The development of derivatives, securitization techniques, and global investment funds has expanded the range of dollar-denominated financial products. These innovations strengthen network effects by increasing the number of economic actors relying on dollar-based financial infrastructure. Monetary policy spillovers and global liquidity cycles. Changes in UN's monetary policy affects global capital flows because investors respond to variations in interest rates differentials. When the Federal Reserve increases in interest rates, capital tends to flow towards dollar assets, appreciating the currency tightening and financial conditions globally. Countries with dollar-denominated debt may experience increased repayment burden when the dollar strengthens. Conversely, expansionary monetary policy can stimulate global liquidity and encourage investment in emerging markets. This spillover effect illustrates how the issuer of the dominant currency influence over internationalization of financial cycles. The global economy becomes partially synchronized with US policy decisions, even when domestic conditions differ across countries. Monetary policy transmission operates through exchange rates, capital mobility, and investor expectations. The dominance of dollar amplifies the global impact of these channels. Geopolitical implications of dollar hegemony. Currency infrastructure as strategic leverage. Control over payment systems and financial clearing networks provides tools for exerting geopolitical pressure. International transactions denominated in dollars often pass through financial institutions subject to US jurisdiction. This structure allows the United States to impose sanctions by restricting access to dollar clearing systems. Countries excluded from these networks face difficulties conducting trade and accessing international finance. Financial sanctions illustrate how monetary infrastructure can function as an instrument of foreign policy. By limiting access to global liquidity, policymakers can influence the strategic behavior of states without direct military confrontation. Economic coercion becomes feasible because of the central position occupied by dollar within international payment networks. The ability to monitor and regulate financial flows enhances strategic flexibility. Military alliances and monetary alignment. Countries' security arrangements often coincide with economic alignment. Countries that rely on US military protection frequently maintain economic relationships denominated in dollars. The interaction between security guarantees and financial cooperation reinforces institutional compatibility. Strategic partners create incentive for maintaining stable money arrangements that support defense coordination. Military expenditure and defense cooperation agreements are often denominated in dollars, further embedding the currency within global security architecture. The relationship between defense spending and financial market highlights the multidimensional nature of power. Economic influence supports military capacity, while security alliances reinforce monetary stability. Emerging challenges to dollar dominance, multipolar economic expansion, and currency diversification. The global distribution of economic output has gradually shifted towards emerging markets. China, India, and other rapidly growing economies have increased their share of global trade and investments. As economic weight shifts, incentives arise from diversifying reserve holdings and settlement currencies. Efforts to promote regional financial cooperation and alternative payment systems reflect attempts to reduce exposure to dollar volatility. The internationalization of alternative currencies requires more than trade volume. Reserve currencies must provide stable legal frameworks, transparent governance, and deep capital markets. Countries considering diversification evaluate the credibility of institutions, the predictability of policy environments, and the liquidity of financial assets. The transition from one dominant currency to another historically occurs when over extended period of time. Technological innovation and digital currency systems. Advances in financial technology introduces new mechanisms of transferring data value across borders. Blockchain-based systems enable peer-to-peer transactions without reliance on traditional intermediaries. Digital currencies issued by central banks may create alternative settlement networks capable of bypassing existing infrastructure. These developments could reduce transaction costs and increase competition among payment systems. However, technological feasibility doesn't automatically translate into systematic trust. Currency systems depend on credibility, stability, and regulatory acceptance. Volatility and governments uncertain limit the adoption of decentralized cryptocurrencies as reserve assets. Digital payment technologies may complement existing systems rather than fully replacing them. Strategic fragmentation and financial regionalization. Geopolitical tensions encourage countries to develop parallel financial arrangements to mitigate vulnerability to sanctions. Regional development banks, bilateral currency swap agreements, and alternative payment systems represent attempts to create redundancy within the international financial architecture. Fragmentation reduces reliance on a single dominant currency that may increase complexity and transaction cost. Regionalization may lead to a more diversified monetary policy system in which multiple currencies coexist. Such a system could reduce the concentration of influence while preserving global trade integration. The balance between efficiency and autonomy becomes a central consideration in designing future financial institutions. Persistence mechanisms supporting dollar dominance, institutional credibility and legal stability. Confidence in legal institutions support investors' willingness to hold dollar-denominated assets. Predictably, contract enforcement reduces uncertainty and encourages long-term investments. Institutional quality function as an intangible asset combining to one currency attractiveness. Investors consider Regulatory transparency and political stability when allocating capital. The credibility of institutions cannot be replaced quickly. Historically, reputation influences expectations about future policy behavior. Countries seeking to promote alternative currencies must develop institutional track records demonstrating reliability and openness. Trust accumulates gradually and cannot be imposed through policy declarations alone. Network externalities and coordination equilibria. Currency uses exacerbates strong network effects because the value of a currency increases when more participants adopt it. Firms prefer invoicing in widely accepted currencies to minimize exchange rate risks. Financial institutions design products aligned with one dominant currency to maximize market access. Once a currency achieves critical mass, switching becomes costly due to the need for coordination among numerous actors. Coordination equilibria creates inertia within the international monetary system. Even if alternatives offer theoretical advantages, economic actors may continue using established currencies because they expect others to do the same. Expectations reinforce existing patterns, producing persistence even in the presence of structural change. Future trajectories of the international monetary system. Gradual evolution rather than abrupt replacement. Historical transitions between dominant currencies have occurred over decades than in years. The shift from British sterling to the US dollar unfolded gradually as economic and geopolitical conditions evolved. Similar dynamics are likely to characterize future developments. Incremental diversification may occur without eliminating the central role of the dollar. Hybrid systems combine multiple reserve currencies may emerge, reducing concentration risk while preserving efficiency. Regional currencies may gain prominence within specific trade frameworks, while the dollar retains global liquidity advantages. The technological innovation may improve interoperability among payment systems, enhancing flexibility without disrupting stability. Strategic implications for policymakers. Countries must evaluate trade-offs between monetary autonomy and integration efficiency. Participation in a dominant currency system provides access to liquidity and investment opportunities that may reduce policy interdependence. Diversification strategies aim to balance these considerations by maintaining exposure to multiple financial ecosystems. International cooperation remains essential for maintaining financial stability. Exchange rate coordination, regulatory harmonization, and crisis management mechanisms require institutional dialogue. The future of the global monetary order will depend on the capacity of states to adopt evolving economic realities while preserving trust in financial institutions. Conclusion. Monetary power as a structural constraint and strategic resource. The hegemony of the US dollar reflects the interaction between historical contingency, institutional design, and geopolitical influence. Currency dominance generates structural advantage that extends beyond economics into diplomacy and security. The persistence of the dollar system demonstrates the importance of credibility, liquidity, and network effects in shaping global coordination outcomes. Challenges to the dollar dominance rises from technological innovation and economic diversification, as well as geopolitical fragmentation plays a great role. Systemic change occurs gradually because monetary systems depend on trust accumulated over time. The global economy is likely to revolve towards a more diversified structure without abandoning the efficiency provided by a dominant reserve currency. Understanding dollar hegemony requires recognizing that monetary arrangements depend and reflect deeper distributions of power. Currency systems shape the incentives facing states, influence policy choices, and determine the range of feasibility as well as feasible economic strategies. The future of global monetary order will depend on how effectively institutions adapt to changing conditions while maintaining confidence in the mechanisms that facilitate international exchange.